Welcome back to Squawk Box. Credit Suisse shares plunging after the bank posted a huge third quarter loss, announcing a major strategic overhaul.
Well, shares in Credit Suisse plunged to a record low, falling 24%.
UBS acquiring its embattled smaller rival, Credit Suisse, in a $3 billion deal negotiated by the Swiss government.
In March of 2023, over the course of a single weekend, one of the most powerful banks on earth was completely wiped out. 167 years of history was negotiated away in a Zurich conference room between Saturday and Sunday because the Swiss government had to have a deal signed before markets opened in Asia on Monday morning. I still remember when I first heard that Credit Suisse was bought out by UBS, and I was shocked because CS always stood right below the big three bulge bracket banks and was always considered to be a lot stronger of a bank than UBS. That's why I was so intrigued by this story, and the more I looked into it, the more dirt I dug up, and the more I realized that the fall of Credit Suisse wasn't just a sudden shock due to one bad mistake, but due to bad management that compounded over decades, and honestly, I'm surprised the bank didn't die sooner. Credit Suisse was a rotting institution for many years, and today we unfold it all. The countrywide financial scandals Credit Suisse was behind, the money from dictators and the Yakuza the bank hid from the world, and even corporate espionage that led to suicide. This is the story of the rise, the rot, and the collapse of Credit Suisse. For almost 2 centuries, Credit Suisse's best business was managing money for the global ultra-rich, and a huge part of what those clients were paying for was access, private companies and deals the rest of us simply couldn't touch. That economic gate is still up. Anthropic, OpenAI, ByteDance, Stripe, the best companies now stay private for a decade or more, and by the time they finally IPO, most of the return has already been captured by the investors who got in early. Jarzi is the sponsor for today's video, and they're opening the gates by giving people economic exposure to private companies with tokens backed one-to-one by real equity they purchased on the secondary markets. Here's how it works. The purchased shares sit in a dedicated LLC, and tokens are issued against those holdings that represent shares one-to-one, meaning you buy one token of Anthropic and that's worth exposure to one real share. You hold, and once a liquidation event like an IPO occurs, you get paid at the exit. You're able to invest with as little as $10, and if you're interested in investing in private companies before they go public, check out Jarzi using the link in the description. And with that, let's get back to the video. To really understand Credit Suisse's downfall, you have to go back to where it all started. Our story begins in 1856 when Alfred Escher looked at Switzerland and saw a poor country fresh out of a civil war boxed in by giants like France and Prussia. Escher wanted to modernize the country by connecting it to the rest of Europe by rail and funded the construction of railroads by founding his own Swiss bank, which we know today as Credit Suisse. Through financing the railroads and electric grid, Credit Suisse was slowly woven into the identity of Switzerland, and for over a century, the country's most important bank built a reputation for discretion and stability. But there was a second ingredient that turned Credit Suisse into a famous global powerhouse, and that was secrecy. In 1934, Switzerland made banking secrecy the law, where sharing a client's personal information could land you in prison. Officially, this was about protecting people's privacy, but in reality, it was a magnet for the wealth of the world, and a lot of the money was there for one reason: to hide from taxes. Swiss bank accounts became famous in movies and pop culture, and a real mystique around Swiss financial institutions formed. But what most people didn't understand is that while Switzerland had a reputation for keeping your money incredibly anonymous and safe, Credit Suisse was being built on shaky foundations. When you piece all of the various operations to understand how Credit Suisse actually worked, picture it as 3 layers stacked on top of each other, each one riskier than the last. At the bottom, you had the classic and safe Swiss retail bank that took deposits and made loans to regular Swiss people. On top of that sat wealth management, where Credit Suisse invested and advised the fortunes of the global rich. Then in the 1980s, they bolted on a third layer, the risky high-stakes world of Wall Street investment banking, which is where they'd eventually buy a firm called First Boston. Now, here's the thing about this structure. The safe retail banking layer at the bottom was reliable but slow. The real money that could make management rich and turned Credit Suisse into a staple name on Wall Street lived in the two riskier layers on top. And chasing that kind of money meant taking on shady clients and looking the other way with each risky bet. And that was the pattern that would define the bank's next 150 years. Because for all its prestige and all its talk of Swiss stability and neutrality, Credit Suisse would spend decade after decade getting caught doing things it shouldn't, paying fines, and carrying on like nothing happened. And every time they got away with it, the next thing got just a little bit bigger. The first big crack came in 1977 in a tiny Swiss town called Chiasso, right on the Italian border. A branch manager there had been quietly funneling over $2 billion of Italian money out of the bank and into a shell company off the books without Zurich having a clue. When this blew up, it became a national scandal, and as much as it should have been a wake-up call, it wasn't. Things just got darker over the following decades as Credit Suisse kept turning up as the bank of choice for exactly the kind of people you'd hope a respectable Swiss institution would turn away. There was a laundering and hiding of money for dictators and their circles, names like Ferdinand Marcos of the Philippines and later Gaddafi. There was even money linked to the Japanese Yakuza. Time after time, the same thing happened where questionable wealth showed up and the bank took it without anyone asking too many questions. And then throughout the 1990s and 2000s, Credit Suisse went from looking the other way on shady clients to actively breaking American law. The bank was caught deliberately stripping identifying information out of transactions so it could move money for Iran and other sanctioned countries right through the US financial system without anyone in Washington noticing. And eventually, the firm had to pay a $536 million fine in 2009. Now, when you look at every single one of these scandals on its own, they're each pretty survivable. Every single bank gets in trouble, and all they had to do was bear the classic fine or settlement and some bad PR. But instead of cleaning up and trying to put an end to all of it, these guys pretty much just never learned their lesson. By the time the 2008 financial crisis rolled around, Credit Suisse had spent decades quietly learning that the rules were more like suggestions and that even when you get caught, the consequences never really stuck. That mindset was about to run headfirst into the biggest test the banking world had ever seen in generations, and how Credit Suisse came out of it set the stage for everything that followed. When the Great Recession hit in 2008, the biggest banks on earth were lining up with their hands out begging their governments for bailouts, but Credit Suisse didn't take a cent. Instead, the bank decided to raise their own private capital by avoiding the Swiss government and turning to sovereign wealth funds and wealthy investors in the Gulf, most notably Qatar, who pumped in billions in fresh capital. And because they loaded up on debt-like instruments and private money rather than taxpayer funds, this meant Credit Suisse never had to hand the government a stake or submit to the strings that came with a public bailout. Meanwhile, the bank's neighbor and arch-rival UBS needed a massive state rescue to survive, and Credit Suisse walked out of the worst financial crisis in generations still standing and looking stronger than almost anyone around it. But that would essentially be Credit Suisse's peak because over the next 2 decades, everything would unravel scandal after scandal. In 2014, Credit Suisse pleaded guilty to a criminal charge for helping American clients evade taxes for decades and had to pay around $2.6 billion. Then came the Mozambique tuna bonds, where Credit Suisse helped arrange $2 billion worth of secret loans to the government of Mozambique. This was money that was supposed to fund the country's fishing industry and maritime projects, but instead, huge chunks of it got diverted into military equipment and thin air. When these secret loans came to light, foreign aid to the country dried up, the currency collapsed, and Mozambique was tipped into a full-blown economic crisis. For this fiasco, Credit Suisse paid a $475 million fine and forgave $200 million of debt as it pled guilty. And then in 2019 came the most notorious scandal that sounds like it could have came from a Netflix crime thriller. Credit Suisse's CEO, Tizan Thiam, had just managed a 3-year turnaround that resulted in the bank's first annual profit in 4 years by 2018. His entire strategy involved pivoting from investment banking to wealth management, which was led by Iqbal Khan, who delivered an 80% increase in divisional profit and brought in more than $46 billion in net new assets between 2016 to 2018. The two were absolutely crushing it, but what started as a friendly relationship turned toxic fast. Kahn bought a house on Lake Zurich right next to Tiam, bulldozed it, and redeveloped it over 2 years, which resulted in annoying constant construction. Potentially in retaliation, Tiam planted a row of trees along the property line, which partially blocked Kahn's view of the lake. And on top of this, Kahn was getting increasingly frustrated that he was being kept out of the spotlight and that he wasn't being publicly anointed as the bank's heir apparent. All of this would really blow up in January 2019 at a party Tiam hosted at his house, and a heated argument between the two required physical intervention, and the two had to be separated and were barely on speaking terms afterwards. But all of this isn't even the crazy part. In July 2019, Kahn resigns and defects to arch-rival UBS, causing Tiam to have massive paranoia that Kahn will take clients with him. What eventually becomes known is that Credit Suisse hired a private investigator to follow Kahn, who at one point alleged that 3 men chased him through Zurich by car and on foot, ending in a physical confrontation. Credit Suisse's CEO was the one who ordered the investigator, and he was eventually fired when all of this came to light, and Tiam was found to have no involvement, but come on. The dark cherry on top of all of this also was that the contractor Credit Suisse used to hire the private investigators died by suicide, which to me just kind of screams a foul play. Eventually, this scandal cost Tiam his job as he lost trust from the bank's chairman and board, while Kahn became UBS's co-head of wealth management and would eventually oversee Credit Suisse's clients anyway when CS imploded. But before we can get to that, we need to talk about the final twin disasters that destroyed Credit Suisse's balance sheet, ultimately leading to its downfall. The first involved Greensill Capital, a British finance firm that specialized in supply chain finance, and it sold itself as a cutting-edge, almost risk-free way to lend money to businesses. Long story short, Credit Suisse bought the story completely and funneled $10 billion of its own clients' money into a set of funds tied to Greensill, and it marketed those funds to its wealthy wealth management clients as safe, near guaranteed returns. Of course, the reality was the opposite. A lot of the money was concentrated in a handful of risky borrowers, and the whole thing was propped up on hype.
Please understand that I bear complete responsibility for the collapse of Greensill Capital.
When Greensill collapsed in March 2021, Credit Suisse had to freeze those funds, and its clients were suddenly staring down billions in losses on the investments they were told were bulletproof. And then just days later came Archegos, the infamous family office run by former hedge fund manager Bill Hwang. Now, to understand how this one took Credit Suisse down, we need to understand a financial product called total return swaps, because that's what Hwang was placing his bets on. Here's how a total return swap works. Instead of buying a stock directly, Hwang would go to a bank like Credit Suisse and say, I want to bet on this stock. The bank would go buy the stock and hold it in its own name, and Hwang would only have to put up a small slice of the value as collateral, sometimes as little as 10%. If the stock went up, the bank paid Hwang the gains, and if it went down, Hwang owed the bank. This meant that Hwang could control a massive position while only putting down a fraction of the money, and because the bank technically owned the shares, nobody could see how much he was really holding. The wild part is that he ran this exact same play at multiple banks at massive scale, so no single one of them could see the full picture of just how enormous and leveraged his positions had become. When a couple of Hwang's biggest positions started to drop in March 2021, the whole thing unraveled in a few days. The banks issued margin calls demanding he put up more cash, but he couldn't, and so they started dumping his stock to get their money back. Banks like Goldman Sachs that moved the fastest and used dynamic margin, which required more collateral as positions ballooned, got out more cleanly. But Credit Suisse not only moved slowest, but also used static margin, meaning collateral didn't increase, and it got out last and worst, eating a loss of around 4.7 billion Swiss francs, the single biggest client loss in the bank's modern history.
And the failures, they are centering around an ineffective risk management, both in the first and second line, and an ineffective oversight in the investment bank and on the risk side around the prime services business.
What's interesting in this event is that Credit Suisse's own risk managers had seen this coming. They had flagged the Archegos exposure, warned that it was dangerous, and pushed to rein it in, but they were overruled by the people chasing the revenue. So at this point, it's hopefully pretty clear to you that it's not just one-off rogue clients that really led to Credit Suisse's downfall, but all of this was more of a symptom of the bank itself. Credit Suisse just wasn't a bank that could manage risk in real time, and all of this was a teaser into the bank's grand collapse, which would all happen in just 10 days. By the time 2023 rolled around, Credit Suisse was already running on fumes. In October 2022, clients pulled 84 billion francs amid concerns about the bank's stability, and things got worse on March 9th, 2023, when Silicon Valley Bank collapses, which is when the 10-day timer begins. The moment one bank goes down, investors start scanning the horizon for the next weakest link, and everyone's eyes landed on the same place: Credit Suisse. In an already fragile state, at the worst moment possible on March 14th, Credit Suisse dropped a bombshell in its own annual report. It admitted it had found what it called material weaknesses in its financial reporting, basically a formal way of saying our internal controls aren't good enough and we can't fully trust our own numbers. Now, in a calm market, that might have been okay, but with Silicon Valley Bank still smoldering and everyone already jumpy, it was like pouring gasoline on a fire. And then the very next day on March 15th is where we come to the infamous moment in Riyadh. At a conference in Saudi Arabia, the chairman of Saudi National Bank gets asked whether he'd put more money into Credit Suisse if they needed it.
The answer is absolutely not.
Now, the chairman wasn't actually saying the bank was doomed. What he really meant was something more boring and technical. The Saudis owned just under 10% of Credit Suisse, and going above that threshold would trigger a whole mess of new regulations that they didn't want.
The answer is absolutely not, for many reasons. I'll cite the simplest reason, which is regulatory and statutory. We now own 9.8% of the bank. If we go above 10%, all kinds of new rules kick in.
But nobody really heard that part. They just heard absolutely not, and that the bank's biggest new investor wouldn't lift a finger to save it. Credit Suisse's stock would drop 24% in a single day, and clients started yanking their money at a pace of billions per day. On March 16th, to try and stop the bleeding, the Swiss National Bank stepped in with a lifeline of 50 billion francs, but even that didn't work. Now, throughout all of this, Credit Suisse actually had assets worth more than what it owed, but it didn't have enough liquidity to meet all the withdrawal demands, meaning Credit Suisse didn't run out of money, it ran out of trust. And for a bank, once that goes, no amount of capital can save you. On Friday, March 17th, Credit Suisse's shares drop another 10%. 4 major banks impose trading restrictions, and 10 billion francs are being withdrawn from the bank every single day. The next day, on Saturday, regulators push Credit Suisse to sell because they can't just bail out the bank over and over again. There was really only one buyer that made sense because remember, the Swiss are a proud, closed bunch, and handing one of their crown jewel banks to some foreign firm was never going to happen. This left just one name on the table, the same rival that had been living just a few hundred yards away in Zurich for over a century, the same rival Credit Suisse had been spending decades looking down on, UBS. So it's kind of crazy that for most of their history, Credit Suisse was the bigger, prouder, more prestigious of the two banks. UBS was the one that got humbled in 2008, the one that took the government rescue and had to build itself into something more careful. And then, 15 years later, that same UBS would be the one bailing out Credit Suisse. It may have held a lot of built-in resentment because it landed like a slap in the face. They opened with an offer of just $1 billion for a bank that had been worth roughly $8 billion just a week earlier, and a fraction of what it was worth in its prime, kind of like offering Anthony Davis for Luka Doncic. Credit Suisse was insulted, but it didn't have any choice, and by the end of the day, the two sides landed on a final price of 3 billion Swiss francs, with Swiss authorities pressuring UBS to finalize the deal before Asian markets opened on Monday. Starting March 20th, 2023, Credit Suisse was no more. 167 years of history completely gone just like that. But the drama does not actually end yet, because to actually get this deal over the line, the Swiss government had to bend some serious rules. Normally, a takeover this size would need UBS shareholders to vote on it, and that could take weeks, so the government passed emergency legislation to bypass the shareholder vote entirely, which is pretty insane. On top of that, it sweetened the deal for UBS with a massive liquidity line from the central bank and a loss guarantee worth billions, essentially promising to eat a chunk of the losses if Credit Suisse turned out to be even more of a mess than it looked. And the most controversial part of all was what happened to bondholders. Credit Suisse had around 16 billion francs of these things called AT1 bonds, and in the deal, they got written down to zero and were completely wiped out. Now, this defies all corporate finance rules because there's a well-established pecking order when a company goes under, where bondholders get paid out before shareholders, always. But in this deal, that order got flipped. The shareholders walked away with UBS shares, while the AT1 bondholders got nothing, and this sent shockwaves throughout the entire financial world. If the rules could be inverted just like that in Switzerland of all places, then suddenly every AT1 bond in Europe looked a lot less safe than everyone thought. All 3,000 of these AT1 bondholders were furious, and together they filed more than 360 complaints trying to claw back what they lost, and until today, they are actively appealing in court in hopes of recouping their funds. So when the dust finally settled, 167 years of history were gone.
To put all our energy and our efforts into turning the situation around. It pains me that we didn't have the time to do so, and that in that fateful week in March, our plans were thwarted. And for that, I am truly sorry.
The proud bank that funded Switzerland's railroads, survived 2 world wars, and walked out of 2008 stronger than its rivals, was sold off in a rushed weekend deal for pennies on the dollar. And I hope that if anything is clear, it's that Credit Suisse did not die from one bad bet. There was no single rogue trader or one market crash that you can point to. Instead, this was a firm that cycled through 4 CEOs in its final decade, each one promising to fix the culture and failing at it year after year. Because underneath all of them was the same rotten belief that had been baked in since the beginning, which was that Credit Suisse was too entitled to ever really face the consequences of their actions. When you stack 15 years of scandals and shady activity on top of each other, eventually the whole thing just has to cave in. Because in the end, Credit Suisse didn't just run out of money, it ran out of trust. And once that's gone, nothing else can save you. That wraps up the video, and if you enjoyed this one, in the next screen you'll see a video on the most powerful hedge fund you've never heard of. Thanks so much as always for watching, and hope to catch you in the next one.